In a Section 1031 exchange, the goal is simple: trade like-kind real property and defer gain. But the moment you receive something that's not like-kind real estate, usually cash, you've got boot. Boot doesn't kill the exchange, it just triggers current taxable gain. On the EA exam, they'll test whether you can separate realized gain from recognized gain when boot shows up. Here's the core rule. Recognized gain in a 1031 exchange is limited to the lesser of boot received or realized gain. Realized gain is the economic gain. FMV received minus adjusted basis given up. Recognized gain is what gets taxed now. Everything else is deferred into the replacement property's basis. Exam tip: if realized gain is zero or a loss, boot still won't create recognized gain. Worked example: Glenn gives up rental property worth $60,000 with a $30,000 basis. He receives farmland worth $50,000 plus $10,000 cash. His realized gain is $60,000 minus $30,000, so $30,000. Boot received is the $10,000 cash. Recognized gain is the lesser amount, $10,000. The remaining $20,000 gain is deferred. Now, basis. In a 1031, gain is deferred, not forgiven, so basis carries over to preserve that gain for later. A quick exam-friendly formula is replacement basis equals adjusted basis of relinquished property, plus gain recognized minus boot received, plus boot paid. If you only remember one thing, remember this: receiving cash lowers your new basis. Paying extra cash raises it. Worked example for boot paid. Charlie's timberland has a $30,000 basis and $70,000 FMV. He trades into farmland worth $75,000 and pays $4,000 cash to make values match. Paying boot doesn't create recognized gain. It increases his replacement basis. So his new basis is $30,000 plus $4,000, or $34,000. That's the carryover basis concept in action. One more exam trap. Don't confuse 1031 deferral with I reinvested the money. Reinvesting proceeds by itself does nothing unless you actually meet 1031 exchange rules. That's why questions will throw in cash sales plus a quick purchase of a new building. Without a valid 1031 structure, the sale is taxable now, even if you roll every dollar into new property. Cedar Ridge Company bought an office building for $400,000. At purchase, it also paid $1,400 of legal fees and $200 of deed recording fees. The offices were used for business a week later. 3 months later, it installed wall-to-wall carpeting for $16,000. Later, it bought office furniture for $20,000. What is the cost basis of the building? Think about it. The correct answer is $401,600. The building's cost basis includes the purchase price plus capitalizable acquisition costs like legal and recording fees. $400,000 plus $1,400 plus $200. The carpeting and the furniture are tempting to add, but they're separate assets placed in service later, so they're not part of the building's original cost basis. Riverton Boutique, a C corporation, bought a warehouse for $940,000. Later improved it by $40,000 and took $48,000 of depreciation. In 2023, it sold the building for $2 million cash, received equipment worth $400,000, the buyer assumed a $340,000 mortgage, and paid $6,000 of the seller's real estate taxes. Riverton immediately invested the proceeds in another building. What taxable gain, if any, is recognized? Think about it. The answer is $1,814,000. Adjusted basis is $940,000 plus $40,000 minus $48,000, or $932,000. Amount realized includes everything received: $2 million cash, $400,000 equipment, $340,000 debt relief, and $6,000 taxes paid on the seller's behalf, totaling $2,746,000. Gain is $2,746,000 minus $932,000. The tempting wrong choice is 0, but reinvesting doesn't defer gain without a qualifying 1031 exchange.